Hey folks, and welcome to this symposium. Today we're going to talk about a trade that was taken by a member. The trade was stopped out, and I was asked why the trade stopped out. So we're just going to do like a quick kind of macro analysis and then go down to the details in the price swings and kind of see if we can figure out what we could have done better or if this was just a loss. That also happens as well. Okay, so looking on the daily chart, you can see that we are super close to this little sideways price movement prior to this departure. So this is telling us that there's obviously a keen interest to buy here. I had an order here to buy which did not get filled, so that one's gone. And the gentleman who sent in this trade had a trade a little bit higher up. So we'll have a look at that now and see what could have happened. So looking at this time frame, I mean, you can see the stuff that we talk about many times in the past is we have something like this. Okay, tested, and finally removed by something in here. Okay, so we can expect price to bounce. Okay, will it bounce? For sure, no, but there's a good chance that it will bounce. Okay, and so looking at the 1 hour chart, which is where this trade was taken, there's a pretty clear setup if you're using the software exclusively, and it was just here. Okay, so the entry was taken here. The stop was placed just here. I'm guessing just below the box or at the bottom of the box. Price came down to this. On the next open, we spiked through, and then price moved higher. Okay, so let's have a look at this area just here to see if we can draw some conclusions. Okay, first of all, if we look at this super closely, you'll notice that we have price sensitivity here. Okay, price. The reason I'm drawing this line is because this is where price stopped. I'm trying to line up where the closes would be. I could probably do it a little bit better and maybe do even something like that, which would depict the truth a little bit more clear. Okay, so we had a test here. We had price went all the way through it. We closed below it. We closed and opened pretty much on it. We closed on it, and this one managed to move through it. Okay, and so in a situation like that, I mean, you ask yourself the question, I mean, where is the origin of the move that was able to remove this area of supply? And this is debatable if it's supply. This is just a price sensitive area. I'm guessing this is more of a liquidity exploration because it's close to a turning point in price. Okay, so we had some tests there, okay, which tells us that we have significant or relatively significant selling at this price point. And then we start to do this stuff, how we have this price going down, and on the histogram we're probably doing something quite opposite. Okay, so this is telling us we're probably going to turn around. Okay, so what we need to do is we need to find the candle that left this base. Okay, and we have, okay, back a telephone call there. So we have this one here, this is now gone. And so you have to find, like, let's try and draw these swings. So we have a swing from here to here, from here to here, to here, to here. Okay. Roughly like that. Okay, so this is perfect. Okay, and so what we want to do is you want to look at the swing that occurred prior to this area of supply being removed. Okay, so this is a candle that went to it. You want to find the low before that, and the low before that is right here, right there. Okay, and so then you would mark off the low. It would be our entry. Okay, and we would put a stop like that. You don't need this anymore. But this is super tight. I mean, if we look at this, how many pips that is? That's 7 pips. On a really bad rollover, you would get spread it out. So you want to widen that a little bit. You might even go, let's say we go twice the size of that. Okay, so we go twice the size of that. That's even pretty tight, especially if it's nighttime. So this is where your entry would go. Your entry, your stop, and this is where you'd expect price to go. Okay, but notice as well notice as well that we had this area here. When price left here, did it dart away like a bullet train? It didn't, did it? It didn't at all. As a matter of fact, I mean, we came down to it, we left, we came down, then we just kind of messed around a little bit. And this is efficient trading. There's no imbalance here. This is not telling us that we have an imbalance in price, supply and demand. This is, but this isn't, okay? The trade would have worked reasonably well. I think that you had the right idea. I think this here should have maybe led you to be a little bit careful, manage this trade very aggressively, because price did not leave quickly. But we did have buy zone established, so we essentially want to be buying below the buy zone. Price poked into this area here. We went down just beyond the lows, which is very, very common behavior, because this is where liquidity is often located. It's normally located above the highs and below the lows in the form of stop losses and stop limits. Okay, and so when you know this, you have to give space below these lows, because price often runs down to seek liquidity that is used to facilitate the filling of slightly bigger orders. And so you can see what you can see here when you look at this. That is that price, when price runs down. I mean, this is telling us that we're likely going to go higher, because, I mean, if you have sideways price movement, so we're between here and here, and you have runs below, another run below, this is telling us that price is going higher, which is counterintuitive. Okay, and the reason it's doing that is because you want to draw people into the market. You want to draw sellers into the market. So when price goes below here, you want sellers to get in the market, because you know that the sellers have their stops around here and around here. And price will eventually get up there, and it'll remove that. So that'll dump this in the market, which will then be used to fill the orders that are required to drive price higher. Okay, removed, used to fill this order, more or less. Okay, and then price will typically draw higher. So you have the right idea, but you have to pay a little bit more attention to the details of these swings. And it's okay to just mark the chart and trade it on demo, or just mark the chart and watch price when it gets there. That's okay. That's okay as well. But it's really important that you do something. A casual look and then moving on to something else. I mean, you're not going to learn anything, but it's just really good practice to talk about this to yourself. You can say, okay, price came lower. Okay, we're at a low. When price is low and price races lower, I mean, what's going on there? Why is price racing lower? And that's because price is trying to find buyers. We're trying to find bids. And these liquidity, these price inefficiencies poking lower and then being rebalanced, this is the market's attempt to find these bids, which are lower. Because if you consider what we spoke about last time, where we have the order book, oops, that wasn't very good here. Order book, we'll go down here because this is where price is. Looks something like that. We have bigger selling up here. Maybe we dry up here. And then let's just change the color. And then we have a little bit of buying here. And then we have big buying here. And you can see that on this candle here. Maybe there's a little bit of buying here. But these are going to be breakout traders. So we have a little bit of buying here, like a buy stop. But this is the uninformed trader. Okay, this is not a good idea. You don't want to buy if price goes above there. If price runs higher, what's it doing? But it's looking for liquidity, typically to drive price temporarily lower, if that makes sense. Okay, so overall, I think you really have the right idea. You just have to give more space, a little bit more air for your stops. You can't have a stop on a floating spread instrument that is 7 or 8 pips. It's simply it's a little bit too dangerous. Also, outside of sessions, the spreads are going to widen. During very very low volume times of day, so out of session or before news, liquidity dries up, and so price gets a little bit erratic, spreads widen. So this can really threaten the health of your position. So you have to give a lot more air for your positions. So in a situation like that, I mean, if you look at what we drew here, you go like this and just give yourself like twice the size. I normally go twice the size. So there's 1 and there's 2. Okay, so that's where the stop would go, and then just go for a 1-to-1 just to see if this trade would have worked out. A 1-to-1. 1-to-1s are really good because they really enable you to build that plus 50% trading model. Okay, I'm winning more than 50% of the time. If you're winning more than 50% of the time, and you have a 1-to-1 risk reward, I mean, you're still earning money. 52% of the time, 51% of the time, you're slowly building up the equity in your account. Okay, and so this just gives you a really good way to watch the market play out in situations where we need some screen time, some education. Okay, cool. Well, I'll leave it at that. I hope that makes sense. If not, let me know and I'll have another go. And thanks for watching. And if anyone else has any trades, either winners or losers, that they want to send in that we can look at, let me know, and I'll be absolutely thrilled to have a look at those. Thank you so much.